Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World. Markets have been actually, going through volatile times after we have seen two consecutive good years, 2020 and 21. 2022 when it started, we had mentioned that this year is going to be tough year, and we are in times which are times for actually deep diving and learning and maybe recreating one's portfolio. And the thought leaders in the industry during these times actually conceptualize and create products, keeping in mind the micro scenario, and kind of ignore macro possibilities, because the idea is long-term wealth creation. And in this regards, kind of we really value some of these thought leaders when they kind of give us direction in this context and remind investors to keep focus on understanding the core fundamental aspects which matter and which actually are fundamental to create long-term wealth. And in that context, we also had this belief, when we started off in 2019, the very first event that we did was done on the concept, on the thought, on the belief of crystal gazing this decade of wealth creation for investors, because we ourselves believe that this decade, which is a 10-year period which started in 2020 till 2030, is a very golden period for investors to build good returns into equities and asset class, especially when we have seen last one decade was not that great for Indian equities, and we saw a lot of reforms happening in last one decade. But I am just giving you the context of this webinar because ASK, which is one of the thought leaders in the space of alternates, has launched a new AIF which is by name Golden Decade Fund. It goes in line with our thought process and our belief, and we have amongst us today Nimesh Mehta, who is the country head director, and he heads product and business development for ASK. I know Nimesh for last more than 10 years when I used to work with Citibank. He's a good friend, and I kind of requested him to have a quick conversation from investors' perspective, not really a sales conversation, but a product-oriented conversation to understand the thought behind this product, and also what is expected by investors in terms of risk return, portfolio construct, and time horizon, which are the basic questions that investors always have if they think of investing in this Golden Decade Fund. So over to you, Nimesh. If you have a presentation, we will first kind of want you to take us through that presentation so that we understand the basic, construct of this AIF, which ASK has launched, and then obviously we will do the questions and answers.
1 second. Yeah, so I'll just load it for 1 second. I will just close this and start this 1 second. They're uploading it. So before I get there, I think since it's taking a minute for uploading, I must acknowledge Kamal, again, a good friend, knowing for a decade. I think the way he has stitched together this PMS AIF world, keeping him focused on the investor, education, and the whole knowledge series which is done. I have always been part and listening to all the events which he has been done. And it's a pleasure for me and also for ASK to represent today and share something, something they started crystal gazing a few sessions back. So it's just taking a while for it to upload. So let's just give it a minute. Should not take so long. Okay, so let's get started. I think, friends, sorry for waiting and keeping you on hold. Just wait for 2 minutes. Right. So I was saying, thank you for giving this opportunity to share our thoughts. What we call the golden decade of equity investing in India. And before we get to the AIF offering, I would now just take you through. We at ASKM always have been talking about sharing knowledge with our investors and our partners. I think we have identified the 6 P's of selecting any equity manager, and they are in this order: the people, philosophy, product, process, performance, and personalized customer servicing. So before I get to the product, I just want to take about 5 minutes time. I'll take for the people philosophy. We'll spend about 20 minutes time here between product and process, and about 5 minutes here. So roughly, I think Kamal had given me about 30 minutes time. We should do justice to that. So as we jump into the people, I think people are the most important differentiating factor in a business. The long-term success of investment business is largely a function of the experience, the wisdom, and the knowledge of the people who manage it. And we are privileged and blessed to share that we have 2 veterans. First, Mr. Manocha, who's the only manager in the country who has managed public equity for more than 30 years. There's nobody else who has managed public equity for 30 years, and you may track that. For the first 10 years, the Birla CEO and CIO of Birla Mutual Fund, and the last 21 years out here. Second, we also have Mr. Pratik Agarwal, CIO and business head with more than 27 years of wisdom. Along with him, he has about 10 plus research come investment team. That's as people is concerned. But few things I wanted to highlight about here. We pioneered the PMS industry way back in 29 Jan 2001, and I'll cover that later. So we are the only PMS which has a 21 years of track record, and that's important because as the investors think, the longer the time cycle we've seen, it's helpful for the investors to select. Second, in terms of when I say we manage 35,000 crores of trust, it is not the 35,000 crores of money. We believe it is a fiduciary responsibility the client has given to us, and therefore we take pride and responsibility in managing that amount of trust. And I think there's a great amount of trust between PMS AIF world and us together, and we want to take this forward. The last part I want to talk about on this, the people part, is that we are a bottom-up equity investors. While there will be something which I'll talk top-down in this approach, but all selection is bottom-up, and we do that. With experienced people comes in a very simple, time-tested philosophy of investing. At ASK, we have always focused on objective 1 and objective 2. The objective first is to preserve our capital, and second is to appreciate the capital. Now, this is in all our offer documents, PPMs, presentations will mention them because it is in our DNA first to look at preservation of capital. That's our mindset to do that. Well, I love to spend about 10-15 minutes to cover the 5 attributes, but I would not get that time here. So we'll focus, but I'll just touch upon 1 or 2 things on each of the 5 attributes we focus on. The first is the size of opportunity. And here, I must say that, we at ASK, I think some of us are responsible for keep highlighting sometime mid cap, large cap, and small cap, which is not the size of the fish. We always believe that it is the size of the pond that matters. The debate whether it's small, mid, and large are all artificial ones. The debate about how, when you look at an investor. So I'm going to share everything about an investor. I've been an investor for the last more than 2 decades, and I always thought that how big the company was in the past, or I think how big the company is, and that is to drive my investing decisions. But it is not about that. It's about how big the company can become in the future. That's the fulcrum point or starting point of investing. So that's about size of opportunity. Always we focus on the size of the pond versus the size of the fish. The second attribute which we focus within the philosophy is the high capital efficiency. We define as the return on capital employed. It is nothing but the character of the company which does not change with times. In the 80s, 90s, 2000, every time. The company which require more capital will continue to require more capital. And we always focus on businesses which has at least 20 to 25% return on capital employed. And that's, to us, is the true test of the character. While we endeavor to have an ROC of 20-25% in our portfolio, most of our portfolio will be close to 35% ROC, whether it's a PMS or AIF portfolio. And this is important to focus on ROC because when you go lower down the drain in terms of ROC, that's when capital destruction happens. If you look at companies like JP Associates, Unitex, Reliance Capital of the world, infra companies of the world, they always have poor return on capital employed, and therefore they have been destructed capital over the last 12-15 years as well there. So that's on the second part. The third piece is a good management quality. Here again, I would bring in the wisdom of Bharat Bhai and Pratik and the board out here. Because when you meet the management, the subjective way of evaluating management over a longer period of time is being able to judge the capability, the vision, the direction, the execution of the management over a long period of time. And that comes with my experience. I must say that we at ASK may not be a very great selector of stocks in terms of identifying very great names. But I must say that we have made the least mistakes in investing and on the management quality. And that's one of the reasons we would say that we've been more consistent than most others is because we always have focused on high management quality. That's a subjective way. The objective way of evaluating a management is simple, is where is the capital allocation happening? Does the businessman put the money in the same business which has core competency, or is investing in some other businesses? We always love businesses which have a core competency and they keep building on that. I give out the best example of Vijay Mallya. He had a great spirits business core competency as a business, but he put that money into airlines, he put that money into sports, and then we know what happened with that. So we focus on management for 2 things, objective and subjective way. Objective as a capital allocation and subjective way as I came out with the experience. The fourth part, people don't come to ASK for just preserving capital. They want to grow the capital. So when it comes to earnings growth, we focus on 2 words, consistency and predictability of earnings. We are sometimes called a little boring investors, but if we are able to find companies which can do 12, 13, 15, 16% compounded consistently and predictably in good and bad times, we will be owning that company for a length of time. And in the next slide, I'll show you something which we've been owning for a long period of time. As Bharat puts it, there's an umbilical cord relationship between the price of the company and earnings of the company. To give an example, in IIT portfolio, we've been owning Kotak Mahindra Bank for long. In the last 10 years, the earnings growth of that company is about 20.2%, and the last 10-year price growth is 20.3%. All things being equal, the price and the earnings converge. And the last part is the valuation, and we will like to buy this entire package. But it starts with in terms of the opportunity, quality of business, management quality, earnings growth, and then comes the value. We always want to buy it as a price to value gap. But here is where the understanding gap is there. Investors believe price is a master, but price is a servant. Value is a master, and value is derived by experience, by the various methods we follow across there. I would say Indians have not created a lot of wealth because most of us start to focus on price to earnings, price to book, and so many things which are jargons or the kind of valuation parameters thrown by the media. But that's not important. Even if you buy something expensive, but it's good, I think it will, over a longer period of time, create wealth for you. To give you a live example to close the philosophy part, the Bajaj Finance rise we've been owning for 10 years. Okay. Now, all of us know how Bajaj Finance done for a longer period of time, but I want to give you a quick closure on the philosophy part. Look at the table down. The yellow color talks about when the Bajaj Finance was a small cap company. The blue color says that 20,000 crores is a mid cap company, and green is a large cap company. If you go down to the last row, it says when in FY11 the market cap was 2,500 crores, it grew 121% in a single year. You just move this aside. FY15, so people say they go small cap kitna fast grow kar deta hai. So then I come back to FY15 when the mid cap 20,000 crores, it grew 131% in a single year. So people say small and mid cap does well. I bring them to FY21 on a 3 lakh crore market cap, it grew 132% in a single year. Now this goes to the thought which I shared with earlier, the philosophy that market does not recognize because you're small, mid, and large. Market recognizes if you have a quality in the business, if the return on assets in case of BFSI portfolio return on equity is there, the quality of management in this case is superb in Sanjeev Bajaj and the team out here, Rajiv Jain. And if you look at the earnings growth, look at the 48% earnings growth for the last 10-year period and 59% of the price growth. So if you look at that in the longer term, the price is ahead of the earnings growth when the market believes there's a huge opportunity. And we believe NBFC is a huge opportunity for at least a decade or longer, I would say for 2 decades out here. And that's where I would like to just sum up in terms of the whole philosophy, which I spoke about, the size of opportunity, the capital efficiency, the quality of management, the earnings growth, and the valuation parameter. So let's move to the reason where we are today. But I wanted to highlight a bit in terms of where we are there. So this, let me just take this down. Yeah. This is our second AIF offering, which Kamal mentioned in the third-party distribution. And how did this originate? So the concept got, the ideation happened in the year 2018 when Bharat wrote this article about the golden decade ahead. And listening to him and reading this article formed this idea in 2018. In those days, we used to always talk about 2 parameters or 2 reasons, pillars for the golden decade ahead, which was consumption and financials there. But after the COVID, when we were reflecting on this opportunity, we found there are 3 more opportunities, which is strengthen the pillar of the golden decade ahead of us. And that's why we've launched this fund. But before we get in terms of the more details about the 3 opportunities which has come post-COVID, let's understand the original concept or what happened in 2018. So the whole ideation was about the transition of the country's GDP from $2.5 to $5 trillion. And then, we say that India will go through it sooner than later. So we try to assess how has been the journey of the other countries in the same period of time. And we found that USA did the journey from 2.5 to 5 in about 10 years time. Japan did in about 8 years time. China happened in 5 years time. We believe India may follow a similar pattern to what US has done. And there are 3 Ds which we believe could have a resonation towards what the USA has been there. The first D is a demographic dividend. 45% of the population in US in the 80s were the working age population. Exactly the same pattern has been with the country today. If you look at in terms of the most populous country, China had the same advantage. If you look at the China, the last 10, 20 years has been a great opportunity for China because their median age of population was in the range of 25 to 40 years. Now, India is set to cross China in the next decade, but in the highest population of the country, but we will be at least 10 to 12 years younger than that. The peak period of the time when the country has been able to have the highest productivity is in the range of between 25 to 40, 45, and that's something we believe is exactly what India is able to do. And till about 2050 also, our average age is going to be about 37, 38. And therefore, we believe, Bharat says it's not a 1 decade, but 2 decade of growth which is there. The second D is a household debt to the GDP. In the 80s, US is about 30% of the household debt to GDP. If you look at India, we're about 12 to 14% now. Okay. And why do you think? So from 2000, in year 2000, only 2% household debt to GDP, and it became now 12%. Now, why do we believe that this is going to shoot up? The multiple things there. Why were it not there? First, I think Jandan most of the Indians were never in the financialization or in the mainstream banking out there. Jandan brought about almost most of the population having one bank account. So what happens when you get a bank account? You probably get the first debit card. Your the credit worthiness starts to give do. The bank starts to give loan. NBFC starts to give loan, and therefore gradually and sooner or later the penetration starts to happen. And that I would say is very, very important to do that. So number of credit cards at a point in time, it's only about 30 crores. Now at about 90 crores in terms of debit cards are being in the marketplace out there. We have 6.8 crores in terms of credit cards. And what it does in the younger population, what we have seen in terms of they would want to achieve their goals by using finance as a medium to do that. And therefore, this is the second D, which is important. The third D is, if you look at the US history again, President Reagan actually did a slew of reforms in 1980s where it actually pulled the government out of the private sector. It cut down the corporate tax rate from 70% in US to down to 30%. And he said they had no business to be in business. And what we have seen over the last 7, 8, 9 years in this country is that the same language or the same communication has been by this government trying to say that they are supposed to be out of the private sector. And if you've seen the slew of reforms from economic side to socio-economic and infrastructure, I think by itself it is going to be has created, I would say, the platform for this golden decade success, and we will see some of it out there. The infrastructure development which has happened, I think will take the country to a whole different level. Let's evaluate in terms of how has been the success for some of these reforms out there. If you look at in terms of the ease of ranking, some of things you know it, but it's always reflection, because when we are within the country, we sometimes take some of these things for granted. But to be able to have, or from 130 rank to 63 is a significant achievement in the last 4-5 years for the country. And that's a great success of this government. This is very big. To be able to have IT exports more than the oil imports is phenomenal opportunity and phenomenal stuff, and it should credit the IT industry for it. Hats off to them, and I think they're growing stronger and higher. Lastly, the GST, I think most developed economies have failed. I don't know whether you all have known, but even the most of developed economies have failed to create a GST in the entire country in a complex structure India to be able to do. There were enough and many people not believing this story. But for the last 6 months, it is more than 1.3 lakh crore. Okay, and that is a very, very big achievement to build there. So all this put together is just I'm trying to say that both all the kind of reforms has been led to a success of the golden decade. But now, what are the things post COVID? Why are we so convinced about it? And what it says that sometimes what cannot happen in decades can happen in a year, and the digital revolution, which initially started in the country to demonetization, actually has reached to a great strength today in the country. In India today, 1.2 billion people have wireless subscribers in terms of which is humongous for a population of 1.3 there. The broadband penetration in the country used to be about 14 odd crores about 6-7 years back is about close to about 84 crores of people having a broadband connection. And that is where I think the foundation of all the fintech, food tech, and edutech has happened, is because of the access to the kind of success has happened. If you look at a very simple analogy, because sometimes the data, the COVID vaccination success has happened on COVID app. Now that has happened because wireless subscribers, that has happened to broadband, and the best of the developed economy has not been able to use a digital platform for COVID certificates. We've been able to do that. Today, all the developed economies want to come to India. They're asking how you've been able to do that and want to take this to their country. That's a lot of pride for a country to be able to have that kind of success to be able to do that. Today, 1 out of every 13 unicorns in the world is happening in the country. We have beaten, last year we did about 46 unicorns. Just imagine a few years back, there was not even a single unicorn yet. And if you speak to any of the Baijus and all the best of the success unicorns, they've been saying it is largely due to Geo and to the broadband penetration which has happened in the country. And we expect to have 100 new unicorns in the year 2022. The second part is UPI. UPI is a purely Atmanirbhar or the India story to say to that. I was surprised to read the data. If you heard this data, we do 10,000 transactions every second. Couldn't believe it. 10,000 transactions every second. And look at the way Indians have adopted to the digital way of things. Anybody, vegetable vendor, the coconut water seller, anybody, chai wala, everybody is able to do the adoption. And there were murmurs and questions whether this will be successful in the country or not. But we have beaten the best of that. The transaction in 2020 was 25.2 billion transaction in the country versus 1.2 in US and about 15 billion in China. So we have taken a leap ahead and much, much fast than what all of them have been able to do. It shows here how the debit cards have got up to 90 crores now compared to the digital payment transactions have increased 5 times. The number of transactions actually is going to go berserk. And this is the power. I was reading a report of McKinsey which talks about $1 trillion GDP opportunity only by way of digitization. So this is something what we say post-COVID, and this has a huge ripple effects not only in the IT industry, but it has a huge opportunity. IT industry, as if I can speak about it there, any crisis post-COVID, the outsourcing has increased out there. So we will see a 15-20% kind of a growth, which was not the kind of growth we were seeing in the pre-COVID period. The second part of the story in COVID is there, which came out very startlingly. Though the foundation of manufacturing was built in 2019, when the corporate tax rates for new manufacturers cut down from 30 to 15%, which made us one of the lowest in the world. And therefore, if you look at the numbers out here, manufacturing has continued to slip down from 17-18% to down to about 13% and there. But we believe this is completely set to change. And you've seen some glimpses of it in this year. $400 billion of exports, which has happened. I think I have a slide there. $400 billion of exports in a single year, rising almost 37% in a single year, is a significant achievement. Given that, you should remember that we had COVID 2, COVID 3 also. COVID 2 was a bad one. Even then, we could able to achieve that, which really lays the foundation of manufacturing as we move forward. Manufacturing led by the PLI. And I think this is one initiative by this government which appears to be so real and practical, because it's only and only production link incentive is there when you are getting 6 to 8% of revenues only when you deliver the export targets out there. So this is so real. It's not hypothetical. And I'm so happy and proud. I never thought 5-7 years back that Apple will have its manufacturing in the country. In this last year, Apple has done 10,000 crores of exports. Samsung has done 20,000 crores of exports. Just look at this number. 1,300 crores was a total about 4-5 years back we could export. It was more about imports in the country. So it's a double advantage for the country that not only we reduce the electronics imports, but we start exporting out there. And that must get complemented for the PLI journey which is out there. In 2014, if I remember, there are only about 2 mobile manufacturing firms in the country. Now it's more than 200, including assembly units. And people are coming to India. And that is something we should really be proud. And what is the benefit of PLI is there? PLI will lead to the much needed capex, private sector capex, which has been shy. This is in the government capex for last many years. The PLI now in terms of will lead to 2.5 lakh crore private capex. And that is going to be a very, very good opportunity. And if that trickles down, I think the economy sets the on its own out there. The third thing which has happened is in the post-COVID is the world has realized that they cannot continue to have a global supply chain dependent only on China. And therefore, what happened is there import substitution. This government has been looking at import substitution, entire value chain, what you need to do there. Just giving one example of specialty chemicals and chemical industry, which is going to be, I think, an era of a lot of wealth creation happening in this sector. A $4 trillion opportunity globally is out here with almost 30% with China. We in India only about 4%. All the developed economies, things are going, expensive because we now have low regulatory costs, low labor costs. And people have now in the world realized India's IP and R&D expertise out there. And therefore, we would see that, every year we will see 0.5%, 1%, depending on how the faith comes in. It takes time to build up these plants out here. But we believe that this is the third part post-COVID, which is going to be really creating a strong foundation for the journey of moving to the $5 trillion decade. To sum up into one simple slide, the demographic dividend we spoke, the consumption we spoke about, digital India we spoke about, Jam Trinity leads the foundation for doing their robust infrastructure. I think Mr. Gadkari, what's been created is phenomenal what he's doing there. Urbanization, upward mobility. This could have slowed down because we are not going to lift the people from below the poverty to higher, but I think it'll catch up pace now. The GST has another important factor is that it brings down reduction into the cost of capital goods, the retailers' cost. We're still at about 14% the logistics cost in the country. China is about 6%. Once we will bring it down by way of infrastructure and by way of GST and all other simplification, I think the startup ecosystem, we spoke about that. Now, when all of this come into play, what happens, we've seen in developed economy, is the equity markets catch up. The market cap doubled in US in that period of time, in 2.5 to 5, 1.3 in the case of Japan, and it grew 9 times in the case of China. Now, market cap, I wouldn't say that we should focus much, but generally I would say the equity is a lead indicator in the case of developing economies. And we would believe that at least the growth in the economy should be at least similar growth we could see in the equity markets out there. But we are not a broader or top-down or an India player out here. We are focusing on the bottom-up stock selection. Let me give just, so some of these countries, some of these companies, industries, when the country goes from 2.5 to 5, will go through, 5, 10 times growth out there. And if you look at one example, again, taking from US, in the 1980s to 1990s, US equity jumped 10 times or multiplied 10 times. And from 1990s to 2000, it multiplied 5 more times, which means 50 times it grew in 20 years' time. And if you look at then India pattern, over the last 10, 15 years, we've seen from a 3-4 lakh crore of Indian markets has moved up, mutual fund has moved up to almost in terms of 40 lakh crore kind of a mutual fund market. And if you look at the equity, particularly in the last 3-5 years, it is really caught up and it's going to go in line with doing this. So I'm just giving a flavor on the asset management business, how it can be insurance in terms of there. So how do, what happens when the economy grows? The per capita GDP of the country goes higher. And this is the foundation of this portfolio also. The per capita GDP is now about $1928 dollars. And therefore, and I don't know if you're familiar with that, as a country, when it crosses the $1,250 is when the country is focused on roti kapra makan or the basic thing. Once it starts to cross, it starts to have a discretionary, the money which is more than required at our home. And if I look back at my journey, my family, people around me, in the last 10, 15 years has been very, very good, where we could have probably finished the basic requirement there. And therefore, the question comes to mind, what happens when your per capita GDP of the country grows higher? What are a few things which we do there? And as we get there, how do you identify this opportunity is something that's very, very important. So this is a very beautiful book. If somebody wants to read, it's called Value Migration by Adrian Slovodsky. And it highlights in terms of how we're going to look at the value migration whole story in the per capita GDP. So it talks about saying that when there's a disconnect between the customer priority, how the customer wants things, and how the existing business design are there, when that happens is when the value migration. So don't worry, I'll go through many examples for all of you to understand. But disconnect in the way we want to have as an investor, and disconnect in the way actually the companies are offering them. So there are 6 drivers broadly, I would say: technology, cost of capital, convenience, innovation, easier access to funding, or lower switching cost are the drivers, and we will see there how it really people have migrated. And as you see the example, the first thing happens to all of us when our income goes higher. Everybody has aspiration. Even I have a driver who has an aspiration to have his own bike. He has a son to give the good branded clothes. So the first thing which happens with the discretionary spending. If you've seen in this country, from a 15% discretionary spending, it's moved up to 24%. But look at the demand for the products as happened in the country. We are only 2.5% penetration of air conditioners, and I keep going back. I don't even know that if we had air conditioner in any of our rooms earlier then, but it came to the bedroom, then to other room, then to the hall, and the entire this happened. But still, as a country, it's about 12.4% penetration. Refrigerator is about 47% penetration. Washing machines are in the range of about 21% penetration. Just go to see the kind of penetration happen. And from this decade, the discretionary spend is going from 24 to 40. Imagine the kind of the requirement or demand which will happen for both penetration and premiumization. This is one of my slides which I keep talking about. The new generation is not doing things like going through the first level. My parents, in terms of their Maruti 800, we couldn't afford it there, but Maruti 800, and then gradually moving there. People are jumping to straight away iPhone in terms of smartphone. People are jumping to the branded. I sometimes say ACs. We used to have assembled ACs. Nobody assembled ACs nowadays. People buy the Samsung of the world. Places where enough penetration scope is there, enough premiumization. What is happening? Both happening at the same time. People are jumping to the next level. As a Maslow's theory, when you say that we're one falling one another this one, but people are straight away going to a Swift Desire car rather than going to the first level car out there, even in jewelry. So look at some examples are there. People keep saying Titan has reached to his edge where it cannot grow out there. Imagine today, even only 39% organized market. From 77 came down to 62. 10-year CAGR for Titan is 28%. Now, you need to ask yourself a question that whether you are going to go to the unorganized jewelry or going to continue to go to organized jewelry. I'm not saying Titan as such, but anything in organized jewelry. I don't recollect when I used to hold my mother's hand and go to some family jewelers right now. I think we now go to the branded outlets and choose because contemporary designs are there. You want to give in terms of check or credit card, which was not the case earlier out there. So that's as far as the story of Titan, just giving you a flavor of organized jewelry. Another story on the value migration is happening in the retail segment, which is in terms of unorganized to organized retail. Now, it's a huge opportunity out here. Avenue Supermarts came into play just about 4-5 years back. 1 crore invested has become 6 point. So when I'm giving examples of the stocks, I'm not highlighting or talking about that you should buy the stocks. I'm just trying to give you a flavor of how the companies are able to capitalize, and only, as the slide says, only 7.3% is the organized FNG penetration in the country. Can you believe it there? And more companies are doing. Why is that Swiggy's and Zomato's and a lot of people are saying 30-minute delivery, 10-minute delivery? Because that's the size. They want to capture that market. They want to capture that organized market and bring you into the organized sector. Otherwise, we've been used to walk into the Kirana store and do that. I think they will also evolve. And therefore, to me, this is one part of the story. The value will migrate from unorganized to organized. Look at the values migrating from traditional fuels to electric vehicles out here. Reading a Tata Motors article, how they've been able to successfully do it, the electrification, whether we like it or not, some automobiles guys like it or not, electrification is real. And now it has reached to a pace where the J-curve will happen and everybody is now focusing on buying new electric vehicle. I'm looking at, next vehicle, if I'll buy, we'll look at electric vehicle out there. More as a contribution to the environment also, and in terms of the overall efficiency on a longer term out there. So if you look at it in terms of playing out there, so value is migrating from traditional fuels to electric vehicle out there. We have one of the Sona BMW. We bought it there in just about less than a year's time. It has gone up 76% from the listing period of time. So it's an indirect pay. 66% of revenues of Sona BMW comes from the electrification there. So that's as discretionary spending are concerned. The second simple thing, when our incomes have grown, what have we done? We start to save more. So I'm just giving this slide is the most powerful slide you can see on the financials out there. If you go back 20 years and put 100 rupees in Nifty and just left it there, 100 will become 15 times right now, say 16 times right now. It's a phenomenal growth. 100 rupees has become 16 rupees in the last 2 decades out there. But in a BankX, you put 100 rupees then, it's become 41 times. Look at the kind of growth that has happened. And imagine, I remember that in BankX, there's to be public sector over a long period of time, not very efficient companies. We've seen how it works there. But even with that, it very simply says the proxy of the country's growth is the banking and financial services out there, and look at the kind of growth there. So playing within the financial, all of us know that a lot spend time, a lot fast looking at time, that the journey from public sector to private sector is happening, and therefore the incremental credit offtake 59% happening from private sector bank. Even the deposits are increasing 46%. The simple question to investor here is there: how many of you now go and open into a public sector bank? How many you put more deposit in the public sector bank? And in the 10 years from now, will you increase or decrease? The simple answer is there. If you think that you're going to increase and put the money in the public sector, if you think it's going to be in the private sector, then give an example of the Kotak Mahindra Bank, which I spoke to you earlier, HDFC Bank, and so many other banks, ICICI Bank of the world. Even in the insurance, what you've seen here, the first year premium, which was dominated by LIC, I don't remember until about I became CFE, nothing was there in a portfolio except LIC as a portfolio. But after 2007, things have completely changed. And therefore, the new share of the 50% which is happening in LIC may continue with listing and more efficiency coming out there. But I still believe that the public sector to private sector insurance is happening. Penetration of life insurance is not so great and will further go. So there is a huge opportunity, multi-decade opportunity in the insurance sector, and that's something which we would like to play in this fund. There are a few of the opportunities just to give a flavor on each of the sector out there, but I've covered each of them in detail. That Dixon is a part of the manufacturing story. Polycab, the cable and wires, unorganized to organized. It's a huge story, but it's looking at time. I'll move forward there. This is how the Golden Decade Fund in terms of how it's done. So when your consumption 55% is now down to 24 to a discretionary spend. Financials from 44, 29. And the new 3-4 legs which I spoke to you is now close to 50% of the portfolio. As I talked to you, the three things which is the digitization, the IT industry which comes across there, the manufacturing, the PLI story is there, and the China plus export strategy is now almost like a 50% of the our sector holding in this fund. A bit about the terms and about the fund. It's about a 4-year close-ended strategy. It's AIF category 3 fund. There are 3 drawdowns. We're going to take it here. The 30% now, about 35% in about September, October, last 35% in about January or February of next year to there. So roughly about 9 to 10 months to give you about 1 crore of rupees out there. And from there, it'll take about 4 years of closure. So roughly about 4 to 5 years of the fund there. It doesn't have a lock-in period, but we have a high exit load of 5% year 1, 4% in year 2, 3% in year 3, and 1% year. A lot of MNC banks, a lot of people wanted to have no lock-in period out here. So we heard the investors and we given the flexibility out there to be able to move forward there. There are the fixed structures and the profit sharing structures, which again, we can reach out to you. I can do the first structure, 1 to 5 crore, 2.5% management fee, and then performance fee. Up to 2% is the setup cost. Let's move forward. So I spoke about the people, Mr. Bharat Shah, Mr. Pratik Agarwal, and Kuldeep Gangwar, who's been with for 4.5 years, is the fund manager in our portfolio, this one there. Now coming to the 4th P, and I'll run pretty quickly. This is, we are the only manager, whether it's a PMS or AIF, bring you the process, which is a documented process, make us accountable, and I'll take you through how it's there. The top 500 companies of the country is at 96% market cap. Start the universe of selection out there. Then, based on the management quality, which we want to do, 325, 175 companies, we don't want to participate because they're not comfortable with the management. Then we focus on the value migration story. Another about 50 odd companies come down. Then we focus on the ROC of 25% and above and earnings growth of 20%. That brings down the universe to 94 companies. And from this, we take about roughly about 25 companies with almost equated portfolio with about 4% weight to each, based on the psychography, optimization, and valuation out there. Just one thing I would like to highlight here, we have given the flexibility to the fund manager here to give that this number of 25% ROC or 20%, because we're coming out of COVID, we're given the flexibility that something is 20, 21%, have the 25% flexibility at the construct level when you buy them in the portfolio. That's the only way available there. So process is, I would say, the very fundamental, because long-term compounding of our portfolio is a fundamental reason that it's all process oriented. It's not algorithm based, but it's a very defined filtration process, and you can measure there's IP growth, everything out there. So we move to the 5th P, which is the performance part. This is the growth portfolio I'm talking about. Last 21 years, only PMS in the country to have a 21 years of track record. And it's very important to focus here because few answers you get from here. 7% alpha in 21 years. Can you believe it? 7%. People say alpha is not there. Second, in terms of what has happened. So 1 rupee invested, a crore invested in a growth portfolio is now 45 crores. In Nifty is about only 12 crores. Now, a few things I want to highlight. What is the worry today? People are worried about the tapering which is out there. People are talking about the inflation worry there. People are talking about the commodities cycle, all at a peak and bottom. But in the last 21 years, we've seen all of the peak. Crude oil go to 150, then to $20. We've seen inflation double digit and a single digit out there. We've seen all of it. But the investor who stayed invested for the last 21 years believed in the people. I know a client in Pedder Road here in Mumbai who just believed in Bharat Bhai, put the money out here, has got the money 45 times. We also have seen pandemic, which has happened in the once in a century. That also having gone through it, we have been able to person who stayed invested. So we have never timed with 100% equity portfolio. We never ever put into cash, still been able to grow to that level. IP, I will talk about, you know about it there. So 8 times in the last 11 years. This portfolio, which I'm talking about, originally constructed earlier, has done 14% in a difficult period of time versus 10% of Nifty. Let's talk about the same ASK India 25 fund we had done in about 4-5 years back. Why are we doing it now? Because, this is where we observed that in the journey of this 2.5 to 5 year, $3 trillion, the 4 to 5 years are the most prosperous and the most impactful for any country. And we want to capitalize this. And therefore, we did it right now. The last part about the personalized CS and digital onboarding, I'm so proud at ASK, because we are the first in a 9-year-old AIF industry to give a complete digital onboarding for a client. No single paper. Imagine a 4.5 lakh crore of AIF industry, but we were the first to do it. The EOF did very well. The earlier fund is because almost 40% of the clients, individuals, this can be only for individuals, almost all the individuals thrown and loved the experience of doing completely online digital onboarding. So I would, request all of you, when you, work with the PMS AIF team, ask for a digital onboarding, and you will see I did it myself. Roughly in about 7-8 minutes, I could finish off my digital onboarding last time around. I'm again doing it again for myself in tomorrow morning, just to try. Because I experienced myself as an investor. Maybe I'll just stop here. There's something on the PMS side, but I'll just stop here and we'll take questions. On the PMS side, we have WhatsApp transactions. You can do everything. You can do top up and doing there. When we have for PMS investors, we have 24 an app which you can download and be able to work to there. So as I see the time, we are about closer to 4:54. We started 4:20. I'll just stop here, Kamal, and then we can just take questions, and maybe I'll cover some of the things that there. I'll just remove the sharing so we can see each other.
Right, Nimesh, thank you so much for sparing your time. We started with little hitches, but I think the presentation made up for it, because presentation was very enlightening. And I'll tell you, when we started off PMS AIF World in 2019, we were also kind of very positive about the next decade based on all these fundamental factors, which I myself am aware of. And when COVID happened, and then after second wave happened, and all of these, we went through so much kind of volatility, that belief kind of remained, but it required reassurance. And now at these levels, when we know the valuations are kind of high, though we understand that in terms of price to earning, valuations are kind of not that expensive. We were at around 40p 1 year ago, same time, and today we are around 22, 23p. Absolutely. But yes, we understand that markets have gone up so much in last 2 years. We do have this kind of doubt whether markets, from here onwards, will be able to kind of good returns in 2022 or not. But it is a good reminder for investors as well as, to us, when we go through such a detailed and such an enlightful presentation, that there have been a lot of fundamental factors which are working, not only at the demographics level, at a micro economy level, which are actually much more powerful than the macro events which are today going on. And hence, I really thank you, for sparing your time to share all this. So I will now, come to starting the questions. Sure. The first question, which I think, many people on the chat have invested in the earlier Emerging Opportunities Fund that was launched in June, July last year. They want to understand how is this fund different from that fund?
So one of the things, so that was focused, as Kamal put it across, all our strategies are multi-cap or flexi-cap strategies, slightly emphasized on small and mid-cap opportunity. There's about 75% of the portfolio was skewed towards small mid-cap and about 25% large. In this portfolio is actually almost in terms of opposite, where you're talking about 60+% of the portfolio more towards the large. It's truly a flexi-cap portfolio. 60 large, about 35 mid, and about 5% in terms of small. So that's in terms of from a core portfolio allocation want to do there. Then I think Golden Decade portfolio comes in higher there because of the underlying design of the portfolio there.
Right. Any other differences, apart from the portfolio construct, in terms of number of stocks, in terms of, expense ratio, in terms of, I would say time horizon, which you suggest to the investor, because there could be many investors who may want to kind of, repeat their investment with ASK. They might already be invested with ASK, PMS, as well as ASK, Emerging Opportunities AIF. And now, they might be thinking whether we should invest in this fund or not. From their point of view, how would you want to answer this?
So one of the things, I mean, personally thinking as an investor, let me honestly confess, a lot of my incremental money goes into our own portfolio, and I'm happy to share with them. For the reason has been very simple. We try to, the core portfolio holding hota hai na, we try to do too many things in the core portfolio. We try to buy ABC mutual fund, XYZ, PMS, then again, ABC, AIF, and so on and so forth. Unfortunately, in my portfolio, when I realized across there, we had too much of 5 to 6, 7 type of strategies across the core portfolio. Then I realized that I was tracking performance for a long period of time. If I'm looking at closer to 15% with lesser risk amount there, I found, again, I'm talking as an investor, but it's a little bit of, you may not believe it, conflict of interest can happen here. But I'm genuinely trying to say that when I realized that if I wanted to get more close to 14-15% compounded, and somewhere I need to go higher on the strategies or the companies which have highest conviction. So as an investor, when I thought about it there, I said it makes more and more sense for me to put money into the ASK portfolios. And therefore, whenever the bonuses comes in, or any incremental money comes in out there, I've just deployed that money. And I found it very, very helpful for me that I kept increasing a pie. In core portfolio, I don't need to add a new mutual fund. I don't need to add a new AIF. If something is doing well, Peter Lynch beautifully said, the best portfolio, the best time to do a top up, the best portfolio you should own is the one you already own to do a top up. You don't need to do something else. So it could be in the same IP strategy, it could be the same year if you can't do a top up out there. These are one of its times. These are the strategy which you're doing in there. Will not continue to happen there because once you close this fund, will not get opportunity to participate in the golden ticket fund out there. So this again, as ASK, we always are focused on core portfolio. So go back to your own portfolio, core portfolio holding, and say if you have 100 rupees to equity, I would say you should have at least 60, 70%, at least 60% to core portfolio. Now, is 60% of the money today at ASK or something like similar to ASK? That you need to ask yourself there. If it is not, I may humbly request, and it has paid wonders to me, I must say. In the last, again, I'm telling you, COVID I put there, it is done wonderful out there. So bring higher allocation to your core portfolio through ASK, and that brings you lesser risk, lesser volatility, and more consistent performance out there. So that would be a message. As a house, we continue to have a flexi cap strategy out there. But this is something I would say an opportunity, a leadership companies in this, the golden decade, the journey from $3 to $5 trillion which happened. I think we're really capturing that in this next 4 to 5 years, something which will grow much faster. So the earnings of this portfolio could be much faster than many other portfolios, and therefore one should come in there. But broadly, again, I'll come back to say core portfolio holding, increase to ASK is my request to all of you out there.
Sure. Another question, Nimish, when the last fund was launched, Emerging Opportunities Fund, the idea was that there were, a couple of PMSs that ASK has been running for a very long period of time, more than a decade. ASK growth has been running for kind of more than 15 years. Since 2004, then ASK IIP, right, 20 years, right? Since 2000, then ASK IIP had started, and then ASK EOP was last PMS, which was started in 2017. ASK Emerging Opportunities AIF was kind of trying to replicate the ASK Emerging Opportunities PMS, right? So is this particular AIF, which is now large cap oriented, going to have going to replicate the Emerging Opportunities IEP PMS?
There is a. So I got a question. There is a strategy. So I shared with you ASK 25 AIF fund. We had done in 2018 only for one wealth manager, and we had raised about 300 crores. So that time the design was 8 to 10 crores, 10 years. Okay, in 2018 we did that 8 years. So which is again ending at 2026-27, 8 plus 2 years. So that journey we identified then, we got derailed in terms of the country derailed because of COVID. But we're very well convinced that in the next 5 years, this is bound to happen. The question is not whether it will happen, the question when it will happen. And therefore, it will copy the AIF fund, which was done earlier. But since it was a close-ended, you cannot participate. A lot of investors wanted to play this story in by way of this golden decade. And therefore, we created this. And as I said, these are the 4-5 years in this journey are the most prosperous times for any country. And to capitalize on this opportunity is something ASK created, and something which I heard in your earlier sessions as well, the crystal gazing sessions in terms of how we talk about the golden decade. So that's where it tries to play and benefit from doing that. EOF, since you asked a lot of questions, EOF was mimic or in a journey, which will also come in the EOF second series. I'll tell you, EOF was very similar to what IP was in 2013-14, a pure entrepreneurial story. 25,000 crores average market cap in terms of there. Here we're talking of lakh plus crore of market cap there. So that was trying to address a very different audience, something which is a small mid scale space, a leadership there, but will really grow and become very sizable enough there. So maybe we'll request at this point in time, maybe a month or two later, we may bring in that EOF series 2 as well, because a lot of investors wanted to participate. We couldn't do it last time around because they finished out there. But that's playing the turner, that's playing the mid and small going out there. Your established steady company with a high compounded earnings growth should be able to deliver 18 to 20+% of earnings growth would be the play out in this portfolio.
Sure. Of late, I have been seeing, many of these alternate focused fund houses like ASK, many others. I don't want to name anybody else because we are particularly focusing on your fund.
Yeah.
But in general, there has been a trend that more and more of these companies are now coming up with more AIF oriented structures.
Yeah.
So why is this so? Is there a learning, or is there a demand, or are these actually superior structures than PMS?
So I'll tell a lot of people why, and it is the clients I'm meeting out there. Most of the people are businessmen, promoters, or in a big four in terms of consulting firm and all. A lot of companies, see today, a lot of us also cannot invest in direct stocks, okay, because of limitation, and we cannot invest in PMS. We had, at least in the last couple of years, a lot of bankers who invested earlier have redeemed money from PMS because their compliance legal does not allow to do that. But in case of AI, because of fund structure, they're able to allow and do that. And that's, I would say, has been one of the biggest reasons for one or having an interest out there. There's a huge population, sizable population out there. NRI has a population to be able to fund there. Minors to be able to come into fund structure, which cannot out here. Fourth, in terms of, I think a lot of customers also don't want to have the headache of taxation at their end. Okay, they prefer to, in terms of have it through a fund structure. It's an AI fund. And at the end of it, the fund pays the entire long term or short term, and what they get in the hand is post tax and doing that. Because most of them are very busy in their own world out here. So these are the a couple of things that come to my mind where the demand is coming from bottom. That why don't you create an AI structure, which is where we were late to the party, but now we've come to the party. We're trying to help those investors and see that how they can be benefited in all this stuff which is there. Barring that, the strategy remains. At ASK, I think whether you come through PMS platform or AI platform, I don't think any approach or philosophy or investment attribute changes. This is how we able to continue to do that.
So, does this also cover the fact that because AIF is given more flexibility in terms of leverage, in terms of hedging, in terms of participation in IPOs? So, in your context, when you are coming up with AIFs, are you saying that you are not going to participate in any of these flexibilities?
So, yes, very, very good question, relevant. At ASK, we believe leverage is a sure. I mean, some people have, but from our side, I'm saying that leverage is a sure way to destruct your money, mass destruction of human wealth out there, and we avoid leverage in whether the PMS or AI portfolio will continue to try not to do that derivative strategy at all there. But yes, in the first time ever, we have given a flexibility to the fund manager to participate in IPO. He wants to do that. We have never done leverage. We'll never do leverage. No derivative strategy, no pre-IPO, because that's unlisted. See, another thing with ASK, what we understand is that we will do only what we are good at. And we will not do what we don't understand. And what we don't understand, we don't have capabilities unlisted. We don't have capability in the private equity kind of stuff. We don't have capability in terms of, leveraging out here. Many people are there who can do very well. So all the strategy can park it there. So we cannot do and we'll continue not to do. Only flexibility we have provided in this AI is to be able to participate in IPOs. We have not done in the PMS side.
Right. So like, Modi ji is to India. Similarly, Mr. Bharat Shah is to ASK. I think, that is how we relate it. But apart from Mr. Bharat Shah, now, ASK has been taken over by Blackstone.
Yeah.
So, how does it change the, I would say working of ASK? Because this is a long-term investor will be taking. So in that context, investors definitely want to know beyond Mr. Bharat Shah.
Yeah. So fantastic. Again, very relevant and to the point question. This is what I like, Kamal, bringing all the investor question out here. So Blackstone is now owns about 75% of ASK investment manager, the group company out here. But I would like to highlight that it is from the private equity fund. They are financial investors. They are not strategic investors out here. Okay. And therefore, we were talking internally that like we had Advent earlier in the prior 5 years before Blackstone came in there. There were 5 years private equity was there. They were 49% stake to about 78% majority stake. So they may decide to continue or exit after the IPO, which will happen about roughly 5 years from now or whenever period of time. But we as a organization, we as a board, so board doesn't change. The Samir Bhai, Bharat Bhai, Sunil Rokale all continue to be on the board. They are a PE investor, but they bring in a lot of value. And I think we are lucky to be able to have a company like Blackstone, a great global company like Blackstone. And what they bring in is their expertise in scaling up the businesses. We have seen them across various business outline. They've done for Emphasis India, they've done for Sona BLW, they've done for Aadhar Housing, they've been able to scale the business out there. So they bring in that process, experience, expertise of managing scale out there. And what we will see here is there with ASK, we may come out. So there's another reason that AI platform, because they say you should increase the number of platforms. Who knows, if all goes right, we may have a mutual fund platform also for ASK. And that's something which Blackstone is guiding us. Blackstone is suggesting us that because of the capability of Bharat Bhai, Pratik and the entire team is there, we can build in a sizable 1 lakh or 2 lakh crore kind of a company managing equity. Today, we are one of the largest in the country out here. So all this kind of scale will come into there. They'll invest and guide us on the brand. But the best part about the whole partnership is there. They have said investment is the core forte. So they left it for Bharat Bhai, Pratik and the team to left and do the investment side. All the other side of the business, which is the marketing side, the sales side, you'll be surprised. We will be in, my team was only about 6-7 cities. Now we'll be in 23 cities in about a few months from now. So that's the kind of scale will come in out there. Everything else for the investor point of view, Bharat Bhai continues to be the second, the biggest stakeholder in the company. Okay, after Blackstone, I'm saying there. Samir Bhai, and then the Bharat Bhai comes the second biggest stakeholder company. He has a long skin in the game. In Gujarat, he was telling me, Nimesh, we have to build a business for the next 10 years, 15 years, 20 years. We have to think from the investor point of view and get investors and partners who can think from this golden decade. And that's where I would like to stop for this question.
Sure. So, the next question is from the perspective of industry. I'm sure, you have been part of ASK and contribute a lot over last 10 years. And many people out there in industry might be wanting to kind of hire somebody like you, but they may not have been able to. But, I would like you to share your wisdom and your, learnings over last 10 years. What has kind of helped ASK under your leadership to grow in terms of assets? As you're saying, you are market leader. Competition has been there in this industry, very fiercely. But despite that, and despite, the kind of difficult micro scenario over last 10 years, ASK has been able to kind of stay to its number one position. What has been working for you guys, and what are your plans?
So let me share. This is entire credit goes to the company. I cannot take while I'm leading the sales piece out here. The first things first is there, as Samir Bhai always puts across there, that we should, and Bharat Bhai also says there, that we know what we should not do. Okay, very clearly. Very successful part of any organization, any people want to grow there. Exactly, we should know which area we should not get in. And we've never gone across there. That's number one. Second is in terms of stick to the core philosophy and what we've done there. So at any point in time, the 6 P's I talked about there, we have seen there, true to the philosophy, never deviating from the core philosophy of the way, preservation of capital and growth of capital. There have been so many fashions and fads and themes which have come out there. You would have never heard ASK launching ABC kind of an infra strategy, this strategy out there, because we believe that whatever that has to play, it can come into the same strategy which we're doing there, and entrepreneurs are playing a role. So we've never tried to launch thematic or kind of ideas just for the sake of launching unless they're there. Third, in terms of having a self-discipline, the self-discipline to be able to sticking only to quality. Okay, I was I will not name the IFA partner. I was in a conference out here, and a lot of people said that so many AMCs are there in the marketplace. They talk about for a style of investing, but inside when you look at the portfolio, their portfolio is very divergent from what they speak. So they will speak a type of investing, but if you look at the portfolio, it's a B type of it. So when I was just probing that if you do a mutual fund, they said, please do it because we need somebody who can stick to the core philosophy. And Bharat Bhai and his team over the last 21 years at ASK, look at any period of time, has continued to focus on in terms of what is right for the investor. And we have always looked at imparted knowledge. The results of the 35,000 crores of assets is an outcome of a trust. It's not something we've earned out there. He's been consistently doing the right things for the investor, consistently doing the right thing for the partnership which we work out there. And I think it is function of Modi coming in, the India doing well, and our performance, I would say, has been one of the most consistent among all of them. And thanks to all the investment team members of ASK, one of the most, I have times, I'll use without again the name of a person, a lot of bankers say, you guys saved us. Even the COVID time, your portfolio didn't fail and it recovered. It saved us a lot of, anxiety and bitterness with the client out there, and we could build out there. And the entire credit goes to the wealth band team out there. So these are the 4-5 things I would say, most importantly. And I would request all the people who are coming to add the patience and perseverance. This is something we require from you. When you come to us, there could be times we go through difficult times. Okay, it's 6 months in demonetization, we were not doing well. But if you come to us, just show some patience and perseverance, and I think we will achieve all your investment objectives which you're thought to while coming into our portfolio. So I'll stop here.
Sure. This is the last question, which some clients definitely ask, when they kind of come near to taking the decision of adopting ASK's portfolio. Yeah. Is the question, which is on valuations. So ASK is a fund house which is following, and sticking to growth investing, and trying to kind of stick to quality names, right? And hence growth investing as well as quality names, quality in terms of management, quality in terms of business. So obviously this is where the valuation is difficult, and valuation is never kind of fair. How is it that you kind of stick to that confidence and conviction of buying some of the names that we have shown also? Which, for example, Dixon. You talked about Dixon. The PE of Dixon is 140, right? So there are a lot of other stocks out there. So I want you to kind of tell me, is there any thought process? Is there any kind of a change in the thought process? Because last 10 years for India's economy was a period where India's economic growth was degrowing, and hence quality was important, and that is where quality received a lot of money. But now we are in an era where we are adding trillions, like you mentioned, by showing all these data points, and in a growing economy at a very fast pace, the money may not be only going towards quality names, because quality names were risk averse names during risk averse times. So
Kamal, let me answer this. I have not answered it differently, but while you're saying, I just thought about it differently from an investor point of view. Let's say our style of strategy is not apt right now. Let's say as of then, which means the style of investing where the people focus on valuation should do well. Okay. And I have this quote from Desmond Tutu, which says, what we learn from history is that we don't learn from history. Okay. Now, what will history teaches us there? If a particular style of investing, and I remember even the mutual fund days, there used to be PE kind of funds. What PE funds said, that as soon as you cross the average PE of the country, say 16, 17 times, if it goes higher than that, we'll reduce the equity down to lower level, and this moved after 2023, they'll completely become fixed income. Okay. And if that logic was true, and therefore those funds should have outbeaten the IPs or growths of the world by a wide margin. Okay. It's simple, because the investor then, but in the reality, those same AMC's funds, they have merged it into the FlexiCap fund because they have underperformed their own open-ended funds. Okay. So if that's one of the best way of testing out there, so that's as far as the PE funds are concerned. The second kind of thing, there are enough and many players in the market who have talked about it and spoken about it, that the Titans and Asian Paints and Pidelights of the world, which has been owning out for 2017-18, there's a white paper released by a lot of good fund managers, and I respect them. But they had a view that this will not grow at all. Okay. And look at the compounding of that stocks which has happened in the last 3-4 year period of time. So I'm not saying it's an either or kind of strategy. I'm not making them even wrong out there. What I'm trying to say is there that each company has its style of investing. We focus on the 5 attributes out there. If we get the size of opportunity is sizable and growing, so I'll go back to the attribute part and come across there. If the capital efficiency, how do you measure the capital efficiency? How do you measure the quality of management inside the PE out there? Okay. So what does the PE say? PE says is today's price and this year's earnings. But the value is derived over the 10 years period of time. The implied growth rate of the company, is it even at 12, 13, 14% growth, implied growth happens on a consistent basis for a decade, even a 60 PE is not expensive. So what can happen to ASK, that I'll tell you for investors coming there, There could be at a point in time that for a year, the performance for some companies, which are high PE company, may not do anything. Okay. And I am being party of IP as a Page Industries. I have had this music on Page Industries long period of time by people saying, "Aapka Asian Paints, aapka Page Industries is very expensive, Pidilite is very expensive." And over the decades of period of time, what I've seen in, sorry, I thought you lost it. So on a page, what I've done that for 1.5 year, the performance or the price will not move at all. It will remain flat. Okay. But a quarter or two of good performance or earnings, it will do the outperformance of the underperformance for last 1 year. And therefore, the price I have seen of Page Industry is moving up from 7,000-8,000 rupees, or about 2,000 crores of market cap to almost in terms of 50,000 crores or 40,000 crores of market cap has happened in front of me. And all of us agree that Page valuation has not been cheap at all. Okay. So we come for a particular side of investing. And last part, I would say, see, most investors never are able to buy this company in the portfolio. How many people have Page in the portfolio? How many people have Titan? How many people have, I'm saying Asian Paints, HDFC, Kotak Bank? No, I think everybody knows these are best companies, but they're not owning. Therefore, you should give the money to ASK. Because we have the courage, we have the conviction to buy the portfolio. All the other smaller companies, unknown companies, you'll buy on your own. You can create there. But for a core portfolio, because you will not buy Bajaj Finance or Bajaj Finserv because you believe it's expensive, your investors should consider giving to ASK because we bring that core portfolio to the client out. So I'll stop there for that.
Right. Thank you so much, Nimesh. And I think, it's my responsibility from the context of investors, because we represent their side, to ask all kinds of questions. And, you have answered all of them bang on. And my own, conviction is definitely there, because I believe that growth investing is a perennial way of, building wealth. And obviously, growth investing comes at definitely, higher valuations. And if we do growth investing by sticking with high conviction and sticking to the 6 Ps that you mentioned, then definitely sooner or later it delivers. One only requires a long-term horizon, and that is.
I'll give one example. Sorry, Kamal. Infosys in 2001 with 100 plus P. Even if you bought Infosys, we are not, but I'm saying there, and held it for a decade till 2006-7, there were no returns. But if you are ended in, at 2010, if you sold it, you've got 16% compounded. So what I'm just trying to say sometimes that even worst case, you said bought something at a very high valuation. If you bring that patience and perseverance to good quality portfolio at the end of golden decade, which is what we're talking about there, you'll be able to do better than what the long-term index is able to do. That's something I request the investor to consider, is to always buy quality at expensive prices, fine there, but not cheaper. Because today also 60% of the market would be available less than 10p. But they don't deliver out there. Sorry, I barged into something which you're saying there, but for the investor.
You concluded it really well. I was myself going to say the same thing. Absolutely. So thank you everyone for logging in today. I think this has been a great learning session, and we'll again do a similar session if required, depending upon how investors kind of come back. Thank you again, Nimesh, for your time, and thank you everyone.
My pleasure. Thank you, PMS, for doing wonderful work, and really acknowledge Kamal and you for the entire team for doing that. Sorry for the IT hiccups which happened at the start.
No worries. Thank you. Pleasure is mine.
See you.